This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners. You can also follow us on our Facebook page at Kronos Investment Partners.
Thank you for joining us on today's episode of the Millennials in Multifamily podcast. I'm your host, John Stober, with my co-host, Fritz Ritter. Today, our guest is Brock Mogensen, partner at Smart Asset Capital. Purchasing his first 89 unit by the age of 25, Brock tells us exactly how he was able to add value to an experienced sponsor, which allowed him to get into his first deal at a very young age. Now with one under his belt, Brock and Smart Asset Capital are quickly expanding into new markets and looking into other assets that are being overlooked by investors. Brock, thank you so much for joining us on today's episode of the Millennials and Multifamily podcast. Could you just go a little more into your background and how you got into the business of real estate investing?
Yeah, absolutely. So I think I've been at it for a little over 2 years now. So about 2 years ago, I bought my first deal, which was a duplex. So kind of bought that, did the house hack thing. And really from there, I think it was, it kind of showed me what's possible in real estate, cash flow and all the great aspects of it. And I kind of from there decided, all right, like where do I want to go from here? I spent time do I want to go the flip route, wholesale? What do I want to kind of accumulate single families? What do I want to do? Landed on syndication kind of being the path I saw myself going down. So for the next 6 months or so from there, I just kind of really just, started learning about it, all the different education pieces that go into it, books, podcasts, different courses and all that. And kind of decided to focus on one aspect of it and become good at that part of it. And that ended up being like the underwriting side of it. So that's really where I spend time becoming kind of fluent in there. So from there, pretty much decided, figured out pretty much I wasn't even able to do it on my own. So I kind of started looking for partners, ended up connecting with one partner, which led to another partner with more experience. Us three kind of all banded together, formed Smart Asset Capital, and bought our first 89 unit deal. And then from there, just kind of progressively bought a few more deals and over the past year.
That's awesome, Brock. What was that first house hack experience like? And could you explain to our listeners what house hacking is?
Yeah, so I'm actually still in it right now. I'm scheduled to move next week. I think that's getting delayed with everything that's going on, but it's been great. I mean, so it's essentially living on one side of the duplex and renting out the other side. For my case, it's upper lower, so same concept. And yes, I mean, my mortgage gets paid each month by my tenants. I live by myself. And it's pretty great. I mean, I think I always tell people it's the best way to get started in real estate, especially if you want to just learn how it actually works. It's pretty simple to buy a duplex, and you just kind of, get an FHA loan, save up a couple grand, buy one, and it really just shows you the process of a deal. And then from there, you can kind of scale up.
Yeah, so each of us actually did this exact same thing. I house hacked a duplex. Fritz house hacked a fourplex with FHA loans. So I'm wondering, how did you go from just house hacking this little duplex, kind of like the very beginning chapter of most real estate investors, to, having the confidence to close on an 89 unit deal?
Yeah, I think, like I said, through partnership, I think was what really kind of did it. I mean, I think I just automatically started thinking bigger, and I realized that it would be hard if I really wanted to, become truly, wealthy from real estate. It was going to be hard to do. I know people have done it, but it's going to be hard to do just buy single families. It would have been a much longer process. So I just kind of figured I'd cut right to it and go the syndication route. And just partnering with people that have already done it. It was really how I was able to do it. So one partner has a pretty big portfolio, in-house property management, the whole 9 yards, and it kind of just being able to kind of find the value I could provide with him, and him kind of trusting me with it brought me on, and we were able to kind of go bigger right from the bat.
So what did that 89 unit look like? How did you guys find that? And what was kind of your strategy going into it?
Yeah, so that one, it was on market, actually on LoopNet. And the reason we kind of got it for the right price was it was under contract, fell out of contract. We stayed in contact with the broker, and then kind of just essentially came in with a low ball offer. the group we were buying it from, this was their only C-class asset they had. Everything else was luxury A-class. I think they were just kind of like, all right, whatever, let's get rid of it. And they sold it to us for a cheaper price than they previously had under contract for. So that's how we were able to make the numbers work. And yeah, I mean, the value add component of it wasn't a huge value add. The value add more so was they were kind of running expenses as it were an A-class. So their expense ratio is more along the lines of 60%. We saw we could run it more in low 50s, given our property management company is they kind of specialize in that C-class type asset. So that's where we kind of saw the value add opportunity.
Mm-hmm. What challenges and hurdles have you had to overcome? I mean, it's obviously a lot different managing an 89 unit C-class asset than it is managing a duplex that you live in.
Yeah, a lot of lessons. It's so it's like I said, C-class. So it's that little rougher tenant base. We actually, upon takeover, not really knowing, we did an extensive due diligence, but one of the things, if I were to look back at it, is I would have gone deeper into actually, being there and like talking to tenants. So we bought that a little under a year ago. I think we've evicted over 50% of the building. So we've had over like 40 evictions. So, an eviction means unit turn costs, vacancy, a lot of expenses come with an eviction. So that was one thing. I mean, we're pulling it together because we came in with the right capital reserves and everything. So it's still working out. But yeah, that's one thing is I think I would do more extensive due diligence on the actual tenant base, like the physical tenant that's in the building, if that makes sense. So yeah, that's one challenge I definitely learned.
So what would you have changed, knowing what you know now when you made your offer and your business plan?
I think that everything else was right. I think what I would do now, just in due diligence, especially in that type of asset, I'd physically go in there and talk to tenants and say, hey, or like even talk to the neighboring properties. What do you know about this property over here? Stuff like that. Really just get kind of the insider scoop instead of just taking the financials and different things that you find on the internet. Really like kind of actually just physically talking to the people that live there, I think is what we'll do on our next, if we were to acquire an asset like that again.
Mm-hmm.
So you say you kind of add value to your team with underwriting. How did you develop that skill? What got you into the underwriting realm?
Yeah, I think it was just kind of natural. I kind of, from the W-2 world, I kind of come from a more analytical role. So I think I just naturally kind of went that way, and I like it. I'm able to kind of, just being kind of proficient in Excel and all that stuff really helps. And I was just kind of able to understand it somewhat quickly, I feel like. And I think from there that kind of transitioned well into like a lot of the roles that go into asset management. So that's where I kind of see myself focusing on now is the underwriting and asset management. Just building out different models and stuff that we're able to use to track KPIs for asset management. I think those two are kind of my essential roles now in the business.
That's awesome. As an underwriter, what do you think is one of the hardest things to project or make assumptions on when you're looking at expenses?
It's a good question. I think overall, just kind of assuming that. I mean, I always lean towards assuming that expenses are going to stay the same or go up even. I don't really like to project that I'm going to be able to run it at a super lower cost. And if I do think I can run at a lower expense rate, I'll do that so over like a 5-year pro forma. I think a lot of people think if I like the 89 unit deal where they run at 60%, we think we can run at like 54, 55. I've projected that over like a 3 or 4 year period that we would bring that down instead of just saying, okay, over day one, I'm going to be at 55% instead of 60%. So I think that's kind of important, like slowly bringing it down. Same thing with rent growth, like slowly bring it up and not just assuming and in the first month you're going to jack rents up and your vacancy is only going to stay at 5%. I think if you are going to assume a trajectory in either direction, do so over like a slower 5-year period on your P&L.
Absolutely, especially with the expense ratio. It often decreases as you increase the revenue, and if it's the expenses sort of stay the same, so it definitely takes time. So you're the underwriter. What were those other roles that you needed to fill out on your team so that way you could get the deal into the closing tables and meet the returns for your investors?
Yeah, sales pretty much, raising capital. I think that's one part. Obviously, we all kind of cross paths, I think, as a team, but that's one part where I'd say I'm more introverted. I'm trying to get better at the different processes that come with raising capital, but that's one part where I lack. So that's where my two partners are kind of stronger and coming from a sales background. So it's kind of worked out well having that dynamic.
Mm-hmm. And do any of those partners, did they have an asset management background or did they have a background with managing multifamily properties, or did they have other skill sets that translated to the syndication business?
Yeah, so that's where so my one partner he accumulated, it was like 200 to 300 units just on his own. They have a full blown, they manage about 1,500 units. So he has a full blown like 40 employee office. So that was where I kind of plugged, and he didn't really know what syndication was. So that's where my other partner and I came in with, this is what syndication is, this is what we can do. And we were able to kind of just be at the right place, right time, and partner up with someone that already has everything we need to kind of get these deals done. So it worked out well where I was kind of able to just transition into something like that.
And I see that must have been how you added value then too, teaching them about the syndication business and the underwriting.
Exactly. Yeah, that was one part where the underwriting wasn't their strong suit. That's where that's what I tell people too that are getting started is, just focus on one. Obviously, as you go on, you're going to learn the other pieces of the business. But people that come in and like try to just become experts in every part of syndication, I feel like it's almost unfeasible. I feel like just become an expert in one part of it, partner up with someone that's an expert in the other part of it. With that partnership, then you grow, and then from there you kind of learn the other pieces of the business. But I think there's just so much that goes into it. I think a lot of people forget, like going into it, that that's ultimately what I tell people: just the one piece. Focus on that when you're getting started.
Yeah, definitely. It's a team sport, and you got to just add value to the team some way. And focusing on one thing is definitely a great idea. In your underwriting, how are you stress testing deals now with everything that's going on in the economy?
Yeah, so I guess I'll speak to kind of what I've been doing. I'll run like two different stress test models, and ultimately the first one's going to be 8% pullback in rents, 15% vacancy, because that's really what the kind of average was in the 2008 crisis. And then my other one will be break even occupancy. Where do we break even on cash flow? I want at least 25% vacancy for that number. Usually it's been more, but yeah, I'd like to see at least 25% there. Those are the two I've kind of been doing. I think as I learn more, just the current situation that's going on right now in the economy, I think I would kind of pivot there a little bit, or just see based on how our other properties are performing when I'm underwriting future deals, kind of where we're at there. Sometimes I'll look at like at a 5 year trajectory, throw in like, random 20% vacancy there just for like potential downturn, stuff like that. So I think I kind of model it based on where I think we're at in the economy as well.
So are you, with the coronavirus sweeping the nation, are you actually just assuming that all of your underwriting is in stress test mode right now?
Yeah. Yeah, I'd say so. I think economic vacancy is going to be is definitely going to be a big factor. So yeah, it's gonna be interesting. I think we haven't seen too much effect yet. So we actually just as well recently bought a strip mall and office building a few months ago. So probably it's not the best time for those asset classes, I'll say the least. But the good thing there is we bought it kind of with the strip mall, especially with the strong tenants that are able to kind of weather a lot of this stuff. But yeah, just kind of talking through that, we have a deal under contract right now that just, yeah, kind of going through there. It's nuts right now with the financial markets and everything. With lenders are just dropping out right now, so we're battling through a lot with that right now.
Yeah. How are you shifting your asset management strategy dealing with all this stuff?
Yeah, it's a good question. I think I'm going to start. It's something. I think just in the past few days, it's really been we've learned what's kind of that it's going to be a lot worse than most people expected. So I think over these next few weeks, I'm going to start building different KPIs into our weekly reports and kind of developing those. I can't say I've like come up with the exact strategy yet, just because we haven't seen an impact yet. I think we've got like just yesterday, we had a call, and I think we just recently starting to get tenants come in saying I lost my job, that type of thing. So we haven't seen the effect yet. I don't think we'll see it in effect this month, which is March. I think towards the end of April is when you're going to start seeing late payments and stuff, because people are just starting to get laid off right now. So I guess I don't have an answer to it yet. What I'm going to kind of do to pivot. I think I'm more so once I start seeing the effects of where we're losing out on income and stuff like that, then I'm going to start pivoting from there and deciding what we need to do to shift.
What kind of KPIs are you looking at right now?
So we got quite a bit. Obviously, the big ones: income, expenses, cash flow, vacancy, all that stuff. And then I'll do a different metrics to track like leasing. We break it down by channel to see what channels are bringing in leases. I follow the same system Neil Bawa uses, that LASL system. So I follow that. I think it's leads, applications, showings, appointments, leases. So that I'll track there and kind of just break it down by a channel level as well, and see like where we're converting on a percent basis on each channel. And then we'll double down. Like Facebook Marketplace has been great for us. So we have a full-time virtual assistant that he's bringing in like 50 leads a day on Facebook Marketplace because he's just all over posting ads and everything. And then we'll break that down. That's been a great channel for us. Stuff like that. We kind of do lease renewal rates to see what our tenant retention is. And then delinquency. Then I also built in recently like unit turns. So on a percentage basis, we'll break down what each unit is costing us to turn on a dollar basis as well. And then break that over year to kind of see where we stand as the years go on how much it's costing us to turn units. So I created it. I know I kind of just went on a ramble there, but I created that template on our website as well. People can check out. That really just breaks it all down well, I think.
So I think that's super interesting what you mentioned about the Facebook Marketplace and your virtual assistant. Could you dive a little deeper into the actual tactics of this? Or is your virtual assistant actually paying for ads, or are they just going into different groups in the marketplace and creating engaging posts to attract leads that way?
Yeah, so we haven't done any paid advertising yet. So we created a Facebook page that he posts on every day. He'll just kind of post random stuff on there. And then as well, the Facebook Marketplace, like you said, he'll repost the ads like on a weekly basis, so they kind of stay on the top. And we tell them within 5 minutes to answer all incoming leads. Obviously, if they come through on the weekend, those get delayed till the weekdays. But yeah, so he's really good about just being on top of that. I've always, any other task we give him, I always tell him that tenant leads are the number one, to answer those right away. And then essentially what he does is he calls them and then books appointments. So we have a set schedule of appointments each week that our leasing agents are there to show the units. And he'll just basically tell them these are our available appointments for the week. And then you'll keep track of those. And then every morning, he'll send it to the leasing agents. Here are the 5 people that are going to show up for the noon appointment. Here are the 5 people that are going to show up for the 5 o'clock appointment. So really, he's just bringing them in. I think that's one thing. It helps a lot because I think when you hire a property management company, the leasing agents, especially a thing like Facebook Marketplace, where you could be getting buzzed all day with different incoming leads. You get 100 that come in per day sometimes. I don't think leasing agents have the time to go in there and answer all of those. They might say they're doing it, but and I don't know. There could be other cases, but I don't think they're answering all of them. So I really think having that system to kind of just forward over actual leads, like vetting out the 90 of them that actually aren't interested or that don't meet our criteria. Like he'll list off, this is our criteria for you to live in the place. Most of them don't meet it. So he's able to kind of filter through all those and just send the good ones to leasing agents, and then they can actually take the time that's required to show the units to those people.
That's awesome. So you basically create a funnel that channels directly into the leasing agents to make their job easier.
Exactly. And at first, it's a cost that we're paying on our own right now. So it's something you kind of have to eat at the beginning. But I think as we acquire more properties, it's going to pay dividends to have that system.
Mm-hmm. Awesome. So how are you tracking where your incoming leads are coming from?
We use AppFolio for our property management software. So all of those go through there. And then our virtual assistant, we give him access to AppFolio, his own account on AppFolio. So he goes in there, adds in all the leads. So that way they're all built into the system. You can choose Facebook Marketplace as a channel that they came in through. So yeah, I think through that, and then our weekly report he sends out, they're also tracked in there. We're able to kind of view where we're getting our leads from.
Mm-hmm. So with the commercial properties, are you using your virtual assistant to market for new tenants that way, or are you using like a leasing broker?
We're using him, and then as well as the leasing agents through the property management company. It's something of it. I think it's harder to find tenants for office and retail, obviously. So one of the projects I have working on right now is trying to find like channels, like possible channels to advertise to. He's found a few for those asset classes, but they're not as plentiful as you would residential. So he's trying, but yeah, the units that we have leased so far for those 2 assets have just been mostly through our leasing agent, his relationships.
Mm-hmm. So could you just tell us, why did you shift to office and retail, or why did you buy those assets?
Yeah, they kind of more so just fell into our laps, I'll say. I mean, through my partners, he's got a full-fledged brokerage as well. So he gets a lot of off-market deals. and those two were off market, direct to owner. And we looked at the numbers, even being very conservative on everything, and we were just like, wow, I mean, right now with where cap rates are, or, I don't know, I think it's gonna change in the next couple of months, but in the past 2 months, where cap rates were, it was just kind of like we couldn't make sense of a lot of deals. They're still out there, but when these deals came through, the triple net leases, we kind of pivoted there. We had to kind of understand the models that come with the office and retail space. But yeah, I think they were just great deals, and we saw the opportunity. We had interested investors to get in those type of assets, and we just ultimately pulled the trigger on them.
So with syndications, we normally unload the property within 3 to 5 or 5 to 10 years. Is this more so a long-term hold with the retail since they're like triple net?
Yeah, our plan is the same thing, like a 7 to 10 year hold period. But the cool thing about those two assets, they're not as big as like a full blown $10 million deal. So we partner with just one group of investors. So it's going to be we'll see what happens over that time, but it's going to be nice because I think we're going to be more flexible on that front. Where say maybe that could be an asset we just hold for life, and we all of us just keep collecting monthly income on it. I don't know, but our plan is to hold it for just the 10-year period, like a normal syndication type deal.
Mm-hmm. And so how is the asset management different for those triple net properties than it is on your multifamily property?
Yeah, that's another good question. So the strip mall was the one that has triple net. We just bought that. We closed on it like 3 weeks ago.
Congratulations.
Yeah, thank you. So we've already got everything built in with our property manager on how the triple net's going to work. We have all that stuff figured out. We actually haven't collected our first triple net portion of the income, so we've yet to kind of break out how that looks as an actual return. But yeah, I mean, it's interesting because when I first saw it, I'll be honest, I didn't really know what triple net meant. I had to kind of do some research on it and kind of understand how it works and what it is. But yeah, I mean, when you build that into the numbers and you start looking at it, I mean, it's nice. You don't really have to pay for any expenses as an owner.
So Brock, with triple net leases, does that include the tenant improvements? Is that incorporated into triple net, or is that something negotiated before they sign the lease?
What we've kind of seen and spoke to the previous owners, it's going to be they build out to spec on how they want it to be. So we have like 2 vacant units. So I think those are more so going to be if someone wants to move in there, they're going to be responsible. Like right now, they're just fully gutted. They're just blank floors, nothing in there. So if they want to move in there, they can build it out to however they want it, but they have to pay for all of it, is our understanding of how it's going to work and how the previous tenants have done it. So that was another thing on that deal is we walk in there and each of these tenants that are in there, they have to have spent, maybe some of those units 50 to 100 grand to rehab them because they're just all built to suit on how they want them. So that was one thing where we're also like, well, they're already in for 100 grand on their unit. So it's really going to have to go bad for them to want to kind of walk away from this. So that's what kind of made us a little more confident too on buying this deal.
Let's just backtrack a second. What does triple net mean?
So triple net really just means billing back all the expenses. So anything that's common area maintenance. So it comes through as common area maintenance. So any expense that falls under that. So it's essentially anything that's not structural. So anything that's not a roof, any large capital expenses like that. So it's almost every single expense you're going to see on P&L falls in that triple net structure.
That's awesome. There must be some huge margins.
Yeah, it helps for sure. But then again, you also have to be more conservative on your expenses, or sorry, on your vacancy. So we were really conservative on there, just in case. Because if one tenant moves out, then because then you're getting hit on the triple net income and the regular income. So you have to be extra conservative there, I think, when it comes to retail underwriting.
Mm-hmm. Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did, so I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting Underwriting ebook and get your free copy today.
Are you offering like free rent or something for a couple of months while they're doing their tenant improvements?
Yeah, it hasn't been something yet where we've encountered like a need to offer that. So we with that asset, we haven't leased any of the two vacant units yet. So I think that's kind of, we're leaving that more on the leasing agent, kind of just feeling out potential tenants on what they're thinking. But we haven't defined a strategic strategy yet with what we're going to offer for concessions on those units.
Yeah, I know on my fourplex, it has a storefront, and we actually offered 3 months free rent for them to fix it up into a smoothie shop that it is now.
Oh, okay.
That's why I asked.
Yeah, probably something we're gonna have to do. I just don't think we've right now, especially like I said, we just got that one. And right now, I don't think most people in retail are looking for a place right now. So we might have to. Can't imagine we're gonna have many leads coming through there for the next month or so, but we'll see.
So I wanted to get into a little bit about your age, honestly. I mean, you're a young guy. You're doing some really big deals. I think a lot of new young investors get intimidated by the size of these deals and just that they're playing out of their league. How have you used your youth to your advantage?
Yeah, it's a good question. I think, I mean, I think I just don't let it really get in the way. Yeah, when you're talking, especially when it comes to raising capital, I think those investors kind of look at you like, well, you haven't been doing it that long. I'd rather invest with someone that's 60 and has been doing it his whole life. And I get it. Experience is the biggest thing when in real estate. But yeah, I think just kind of going towards like, I understand like just staying up to date on like underwriting and modeling and all that stuff. I think that helps a lot. Being able to kind of implement technology into our business is where a lot of like the older generations might lack, like the stuff we're doing with our virtual assistant and all the different components we have. One part where we can kind of, flaunt to investors, this is what we're doing that a lot of the older generations might not be doing, stuff like that. So I think ultimately, though, I don't let it get in the way of how when I'm talking to people. But yeah, I guess it's a good question.
Well, it's something we hear a lot. And what I think is great is you do have these advantages of especially being able to incorporate technology, but then you just partnered up with a more experienced operator. So you have the experience on your resume right now, but there's still ways that you can add value that they may have been missing. Is there anything that you do differently with your branding that you think maybe older, more experienced operators aren't doing? Such as, are you active on social media? Do you have any meetups that you're running?
Yeah, that's a good question. Yeah. So social media is one department I'm lacking, and I think I'm trying to get better at it because I know it's huge when it comes to capital raising. Just building a brand through social media. So we're working on it there. We have our virtual assistant kind of helping us with some stuff on social media, but like the meetup is where glad you brought that up. So yeah, that's where we've seen a lot of benefits. So we started so I guess just going back. So I mean, when you get started, I was going to a lot of meetups. I still do, but at that time I was trying to go to a couple a week, going to a lot of them all throughout Wisconsin. And I started realizing that they're all geared towards fixing and flipping and wholesaling. None were about buying like multifamily. And that's what I wanted to do. It's like, I was always getting frustrated. Like, why is there none out there? So then my partner and I were like, well, let's just start one if no one else is doing it. So we did. Wisconsin Apartment Investors Meetup is pretty generic on the name, but just started that up. Yeah, so we've been doing it now for about a year, and it's actually turned into, just because I've been to all the other ones in Wisconsin, like the largest monthly multifamily meetup. So any like multifamily specific, there's bigger ones out there for the fix and flip stuff. But yeah, it's been great. And then we've had people reach out to us that are attending our meetups and say, hey, I'm up, 2 hours north. Can I host one under this name? So now we have 3 or 4 different locations now where people are kind of using our name and just bringing them in. So it's kind of turned into covering the whole state now with different branches. And it's, it's the relationships we've built through there, the capital we've been able to raise through there. It's been great.
So let's talk about that. How has running the meetup as opposed to just attending other meetups assisted you in raising capital?
Yeah, really. I mean, it positions you as an expert almost. You're able to kind of, at the beginning of the meetup, we're able to stand up in front and say, hey, we put this meetup on. This is our company. And it kind of, at the end, people are like, oh, they want to come talk to you, right? I mean, it's interesting to see just going to meetups or them being the host of a meetup. That, and as well, we're able to pass out a sign-in sheet So I'm able to collect everyone's email address and throw them on an automated email list after that, which has turned into a lot of investors. So yeah, I think just being able to say like I host, even being able to kind of, when you're talking to people, almost being able to brag, saying we host this meetup, different things like that, I think just position you as, you kind of know, even in some cases people might really not even know what they're doing, but just being able to do that is kind of positions you in that right aspect.
Mm-hmm.
So do you recommend people start their own meetups? And if so, what are some strategies they can use to grow theirs?
Yeah, I think it's great to start one. Especially if you're in a market where it's not like saturated. I think in the bigger cities, there might be, I'm sure if you go down like Texas and Austin and stuff, there's a million different multifamily meetups. So it might be harder to start one there. So, but I'm not saying don't do it, but if you're in a market, especially where there's not a lot of them, capitalize on it and do it. Because there's other people out there that are trying to do the same thing as you. They want to put the time in to start one. So I will say three things that we've kind of done that's helped us grow our meetup into we have like 50 people that attend each month, and it's almost we get a lot of different people that come in each month as well. We have our regulars, but then also like new people, which is great. So the kind of three things we're able to do to build it up. So obviously you're going to start a Facebook page when you create a meetup. That's going to be like your easiest way to advertise to people. So what you'll do there is when you create your event, you can boost the post on Facebook. So we'll throw in like $20 a month, and it'll just bring in like, probably, I think it gives like 1,000 impressions to people on there. So a lot of people come through on there for $20 a month. You get a lot of people that attend. And then another thing we did, I did at the beginning, is I went through. It might be almost kind of sneaky, but I went through and I looked up every single like Facebook meetup page in Wisconsin. So there's probably 10 of them that were big in Wisconsin. And I'd go through there, and in all those Facebook groups, someone will post, "Hey, I'm selling this duplex, or whatever," and then you'll have like 50 people post their email address. DM me the info. DM me the info. I just pulled a spreadsheet, spent a couple hours one day, copied down every single email address throughout all those different meetup pages. So I ended up with like 200 or 300 email addresses. Threw those on an email list, and I keep like a running email list of people if they want to be notified about the event. So I blast those guys twice a month, every month with our meetups. So I think we were able to bring in quite a few people off there just right off the bat. And then the last thing, pretty obvious. I mean, just tell your network, post on your personal page. Hey, I'm having a meetup. Bigger Pockets too. I'll go on there, and I have like a filter in Milwaukee. If people post anything about there, anyone that's new to real estate, I'll just DM them. Hey, we host a meetup. Check it out. Here's the link for the event. Just doing those three things on an ongoing basis have been able to just grow us really easily. And now at this point, with everything kind of automated, I might spend a couple hours a month. And that's all it really takes to keep the meetup going.
So could you dive a little bit more into your email marketing system? What type of content are you sending out to people to stay in touch, and what tools are you using to automate your campaigns?
Yeah, so for the meetup specifically, I'll talk about that. I mean, I just use like MailChimp, nothing crazy. I mean, I just keep a running email list. I'll add people in each month when we have the event. I'll take those contacts, throw them in there. And then if people want to be added in, be notified, I'll put them in there. But then I'll send out like 2 emails a month. So it's nothing crazy. I'll just say, hey, here's our list of events this month. And I'll just include the link and a quick description about them. So we try to bring in like different speakers each month as well. Like we had like a panel last month with a few different experienced investors. But yeah, so nothing too creative there. On the like raising capital side, I've built in like automations with we use HubSpot for our CRM, and from there I have like an email. So like when I collect an email address from the meetup, people that we've spoken to, right, just to stay in compliance with everything on SEC, people that we've spoken to, we'll take those and then we'll get them on an email sequence that sends out like 3 different ebooks we've written. It's like a total of like 5 emails that get sent out. And then each one kind of says, here, here's a free ebook download. Here's this, and it kind of explains. And then the last 2 are more so, they're articles we wrote about what is syndication and how to like vet a partner in syndication. And then in there, we'll throw a quick thing. Hey, if you want to schedule a call, learn more about this, click this link. That link brings them into our investor portal. So we just bought like an investor portal software where they can kind of register in through there, get on a call with us. And then we start moving them over towards our investor list.
So what I'm hearing is you provided a ton of free value to everyone who joins your list through these ebooks. And then you had a call to action at the end where they can join your list.
Exactly. Yep. So that's really where at first, I'm not going to come in with the first email saying, "Hey, partner up with us. Click this link." I want to I'm going to provide value for like a month and different things, and then at the end, I'm going to say, "Hey, if you liked all this stuff, let's get on a call," type thing.
Mm-hmm. Beautiful.
So, Brock, what's kind of the next 3 to 5 years look like for you and your company? What are you guys working on now?
Yeah, we're continuing to look at deals. I think we're really starting to try to go for bigger deals. But we're also still making sense of some smaller deals and just kind of partnering almost through a JV structure with different investors. So yeah, I think ultimately our real goal is to kind of start looking at other markets within the next few years. I'm almost kind of thinking about moving down south. My other partner's thinking about moving west. So we're kind of looking to kind of create like a triangle type thing and be able to cover more markets throughout the U.S. But yeah, I think in the immediate future, we're just looking to build a solid base here in Milwaukee, just because we already have a good thing going here. We have the property management in house here, so I think we're looking to build our base here and then kind of expand to other markets with our experience and able to kind of. Cause I think it's harder to kind of go to a new market without the experience. That's why we're kind of just focusing on one market at a time and then expanding once we have the kind of experience to use to leverage.
You said you have your property management in house.
Yeah, so well through my partner's company, right? I'm just saying that because I'm a partner with him, but yeah, so they have a full blown. They have like 25 employees with their property management firm. So they manage a lot of. They have like 1,500 units they manage right now throughout the Milwaukee surrounding areas. So yeah, that's been great because we're able to just kind of plug right in with them, and we have great relationships with everyone in that property management company. So it's been nice, and we're able to kind of market as a vertically integrated firm with that because it's all under the same branding, right? We have Smart Asset Capital, he has Smart Asset Management, which is the management arm, Smart Asset Realty, which is the brokerage arm. So we're able to just kind of plug right in with that partnership and already have the branding throughout Wisconsin, but just changing that last word as a new arm of the company.
And so as you continue to grow into out-of-state markets, are you going to continue to stay vertically integrated, or would you bring on third-party management?
It's something we haven't gotten to spoke about yet, but I think we'd really probably lean towards just third party. I don't know if I'd want to go to each market and build a property management company in each market. It sounds like a lot of work. I don't know. Maybe one day we're able to really get scale in each market, then do it. But initially, I think it makes sense to just partner with third party on the first few deals at least.
Yeah, I'm just thinking of all the vendors and contractors that you would have to develop relationships with before you acquired a property. Whereas if you have a property management company, you can just leverage all of those relationships.
Exactly. Yeah, that's the natural thing that makes sense. I think would just be to partner with third party on at least the first couple deals.
Mm-hmm. So in the short term, I mean, the next 3 to 5 years, you're looking like you're going to start growing into other markets. What does the short term look like especially with coronavirus for the next, let's say, 6 months?
Yeah, I think really just the next few months we're just going to be heavy on operations. I think we're still going to keep looking for deals that come upon us, but I think we're going to shift a little bit from heavy marketing for new deals and just kind of really putting everything we've got into operations and making sure that we're operating these properties to perform well. Obviously, we come into all these deals with good capital reserves, so we can weather a lot of downturns like this. But I mean, yeah, I think these next few months, I don't think anyone knows the extent of what's going to happen. Pretty confident we're probably either already in a recession or going to be in one soon here. But yeah, I think just weathering through, focusing on operations, just really trying to protect the principal, I think is really what it comes down to. Doing whatever we have to take not to lose any principal in the next couple of months is really what our goal is.
Have you noticed any difference raising capital now that the stock market is no longer on this epic bull run and it's fallen like 35% in the last month?
Yeah, that's one thing when we're talking to investors right now is we're able to kind of say, well, how's the stock market looking right now? It's not looking so hot. But I think at the same time, people are just nervous to invest in with the state we're in, right? Like currently, as we're recording this, people are nervous to put their money anywhere right now because no one knows what's happening with anything right now. I think as the next few weeks progress, people will maybe will start getting a little less nervous once we know that really what's going on. But as we're recording this, investors we're speaking to are almost like, I'm interested, but just give me a few weeks. I'm not wiring out any money right now. I kind of want to see how this plays out. But yeah, that's one thing we're definitely leveraging is, real estate's going to do better in the stock market. That's for sure.
Yeah. I mean, I've heard from a few investors that I've spoken with recently. They just mentioned how the stock market has gone up like 20, 30% year over year. Well, now all those gains for the last 4 years have just been completely wiped out. So it kind of levels the playing field a little bit. You can offer stability and safety that real estate offers. So that's awesome. Okay. Let's move into the last segment of our show. It's called our Fast Five. It's the same 5 questions that we ask every guest on our show. So if you're ready, we will kick these off.
Let's do it.
Okay. So if you had to start all over again and you were in your very early 20s, what would you have done differently? If anything, maybe you wouldn't do anything differently.
Going bigger sooner, right? I think if I could go back, I would have right out of college. I wish I would have started studying this stuff in college. And right out of college, I went and worked for a big real estate company. And 'cause I think I would just learn a lot. Like I've learned a lot in my current W-2, but if I would have gone and worked for a big real estate company, I think I could have kind of progressed quicker into it.
Yeah, I definitely feel you there.
How do you see young professionals adding the most value to experienced operators in this space?
I think going back to understanding technology. I think there's so many different. I think it's one part real estate lack. I mean, it's gotten a lot better in the few years, but real estate for the most part is like an older generation's game, right? It's looked as people that are older are the best at it, and what probably is true. But I think being able to come from understanding technology and systems and how you can implement technology into real estate, you can add value to the older generations that kind of might think that it's not worth it to do it. But when you show the results of what you can do with technology, they like it.
I totally agree with the technology aspect of helping older operators. So what's the biggest mistake you've made in your career, and how have you since adjusted your business?
The one I talked about in the beginning, not physically talking to the tenants during due diligence. That's the one thing, right? I said we've evicted over 50% of the building. So that was rough. So that's one thing. That's on our due diligence checklist now, is go in there and physically talk to the tenants. That's the one thing I could say. Yeah.
Mm-hmm.
It's definitely a good tip. What's been your favorite way to incorporate technology and social media into your business?
Technology, as far has been with the virtual assistant, being able to implement stuff with him and plug them in. I think that's really been, and then automate a lot of our reporting as well. That's helped a lot as far as the technology piece.
Mm-hmm. And so our last question is there a book or a documentary that has been the most influential, I guess, piece of reading or literature for you and your company?
If I had to go back to one book, it'd probably be, what really shifted my mindset is the 10X Rule by Grant Cardone. Yeah, I'd say he played a big part in shifting my mindset. If anyone's looking at kind of mindset shift, I think that's a good one.
I can definitely see that, going from 2 to 89. That's definitely 10X. Yeah.
Good old Grant.
Yeah. Well, all right, Brock. Thank you so much for joining us on today's episode of the Millennials and Multifamily Podcast. Before we log off, is there a way that our listeners can get in touch with you?
Through the website, smartassetcapital.com. That's the best way. And then through there, also, like I mentioned, I have some different that KPI template. You can download that on there. That's a great thing for people that are kind of looking to build something on their asset management side. It's an easy Excel download they can kind of use and tweak if they need. But then also my email is brock@smartassetcapital, Brock@smartassetcapital. So if anyone wants to reach out, I'm more than willing to get on a call with anyone.
Awesome. Well, I'm definitely going to check out that download too. All right, everyone. Thanks so much for joining us, and we will see you next time.
Thank you for listening to the Millennials in Multifamily Podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. You can also connect with us on Facebook at the Kronos Investment Partners page. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.